So since our last quarterly forecast, central banks have made some progress towards their goal of slowing economic activity and bring inflation lower. Economic activity has slowed to below trend growth. Inflation has shown signs of decelerating in the goods sector in particular as supply chain problems have improved. Commodity prices have declined, lowering headline CPI. And we also see tentative signs of peaking in the housing sector with rents and housing prices showing signs of decline. Yet other parts of the economy remain resilient. Particularly the services side of the economy remains robust, and this is keeping the labor market fairly tight. The unemployment rate at historical lows and wages higher than what would be considered as consistent with price stability. So these conflicting economic signals bring more uncertainty about the economic outlook for 2023. But given central banks' inflation focus, this means that central banks will continue to raise interest rates, albeit at a more moderate pace, most probably, until they see more evidence of a slowing in the labor market in particular. And this will likely be done at the expense of economic growth. Our global economic forecast continues to expect well below trend in economic activity, with a 1.5% global growth and a risk of recession in certain parts of the world, like in the US and Canada. Inflation is also expected to finish the year well above central banks' targets in 2023. Taming inflation remains priority number one in most developed countries, except perhaps in China. Central banks have reaffirmed their focus towards bringing inflation back to their target, which continues to skew the risk on overshooting and triggering a more pronounced economic slowdown. For example, labor demand is slowing, but remains at an elevated level with jobs open in excess of labor availability. The starting point of inflation remains elevated, and central banks will not be able to relax their monetary policy until inflation is more on its way back to the 2% target. But on the other hand, the scenario of a soft landing remains possible. China's abrupt change regarding its COVID policy is removing some downside risk to the world economy with a rapid reopening. China is also relaxing its policy towards real estate market, again, removing some of the downside risk to growth. And finally, in Europe, much warmer weather than normal is reducing the pressure from energy and may reduce the risk of a full-blown energy crisis in Europe. The outlook for financial markets is likely to improve relative to 2022 for a few reasons. Valuation has improved in many asset classes. Fixed income, for example, the nominal yields are starting at a higher level than at the start of 2022. Real yields, that is the difference between nominal yields and inflation, are positive, where they were very negative at the start of 2022. Spreads of varied credit risk have widened, providing better reward for taking credit risk at the start of 2023. And equity market price earnings ratio have come down to more acceptable level. So continued deceleration of inflation will help improve the investing outlook as central banks slow their tightening effort and reassure at least fixed income investors that their nominal return will not be destroyed by high inflation. Equity markets have so far witnessed a marked decline in their valuation in the form of lower price earnings, moving from overvalued to a more fairly valued level. What is important to assess is how deep the economic slowdown could be to evaluate the earnings outlook. We continue to think that we could see some corporate profit disappointment as analysts revise their earnings forecast lower to account for the coming economic slowdown. Current consensus estimates appear to be relatively high given the challenging economic environment. The last leg of corporate profit adjustment may provide some opportunities for investors to re-engage with equity markets. But in the meantime, we continue to recommend keeping a well-diversified portfolio with a tilt towards non-US equities. While holding cash has been reducing portfolio volatility, we suspect that opportunities will present themselves over the coming quarters to redeploy this cash, given the expected market adjustment. With a continuing challenging macroeconomic environment, investors must build well-diversified, resilient portfolios to make sure they can achieve their financial goals. And as always, staying the course relative to their long-term plan is always the best advice we can give investors, especially during periods of economic uncertainty.